Hey everyone, Phil Stevenson, Mortgage Nerd here. Today I want to talk to you about something serious, something that really upset me. A friend of mine sent me an article, a financial advisor who understands reverse mortgages, Lee Morrison. And the title of this article from USA Today is Seniors Were Sold a Risk-Free Retirement with Reverse Mortgages. Now they face foreclosure. Just that drives me crazy. Because there are layers of protection, so to speak, or layers that have been put in place. You have to deal with a salesperson. Granted, salespeople can lie. We know that. I understand that. But then there's a second layer of protection that came into place in the year 2000, and that's a counseling, a reverse mortgage counseling. A lot of my borrowers are like, "Oh, Phil, why do I have to go through this?" This article says it could be as little as 20 minutes. That's never 20 minutes. 45 minutes to an hour are the fastest I've seen that counseling. They explain everything that I explain. I've never had someone cancel after doing a counseling with me. I've heard of others that it's happened because they hear the truth from the counselor. We tell people all the time, if you don't pay your taxes and you don't pay your homeowner's insurance, you will be foreclosed on. It's not risk-free. But yet this article, scathing article on the reverse mortgage industry talks about that. It talks about how we are redlining. What's redlining? Redlining is something that was done in the 30s, where they would literally draw red lines around certain areas because they would target that low-income area or stay out of that low-income area. Discrimination. A lot of our marketing that they talk about, mailers, TV commercials, things like that, are targeting everybody. Do you really think, if this is saying that we're targeting poor, African American, urban areas, do you really think a loan officer wants to deal with a property that's in shambles, which is a lot of work to get a loan closed, that they want a small loan amount? No, we want the higher loan amounts, the higher home values, the ones that go right through because they have great income, great credit, the property's in great condition. But here's another example of the media taking something and sensationalizing it and making something in the mortgage industry look like we're a bunch of crooks taking advantage of people. And I hate that to the core, especially someone like me who's a certified reverse mortgage professional. I have another video that I just did on that. I'm on the ethics committee of our National Reverse Mortgage Lenders Association. Now, with that being said, being on the ethics committee, we do see kinds of violations like this and people getting in trouble for doing things that they're not supposed to be doing, ethical issues. But this goes on to talk about individual cases. So there's one gentleman in this article named Leroy. It says Leroy, 10 years ago, forgot to pay his homeowner's insurance. Do you see something wrong with that right off the bat? Because if you or I, under 62, without a reverse mortgage, just forget to pay our homeowner's insurance, what's going to happen? The lender's going to put force-placed insurance on your home. It's more expensive than the insurance that you would get on your own, and it's going to add on to your loan amount, and it's going to lead to foreclosure. But it's because he was sold on this risk-free environment that it would never be foreclosed on. BS. Everybody tells you you must pay your taxes and insurance. If your house is free and clear and you don't pay your taxes, you're going to get foreclosed on. It's called a tax lien. Somebody buys it. They hope that they can foreclose on you and take all that equity. It rarely happens. It's like winning the lottery, but that's something that's in there. So to keep this video from being too long, read the article and just know that a lot of that is BS. It talks about that we don't even need to look at credit. That's not true. In 2015, we started looking at credit and income in a strict manner. But before 2015, we still looked at credit. We still wanted to know what was going on. It's just more strict now. So some of these people, they did it before that change. So it's understandable that they didn't have the income and credit needed like we do today. They wouldn't qualify today, most of these people, because we've put a lot of protections in place on top of it. So a lot of it is just even Peter Bell the head of the National Reverse Mortgage Lenders Association talks about that unfortunately a lot of these cases came in before these changes. But it's highly inflammatory. It's really just trying to get eyes on the article, and it works because that's what media does. But take a look at it and understand that most of this is not true. You work with a professional like me, a certified reverse mortgage professional. You work with someone that knows what they're talking about to help people over 62 use their home as part of their retirement with some risk, but if done right, like I did it for my grandparents in 2008, if you do it right, it'll really help someone in retirement. So I look forward to any comments, and reach out to me if you have any questions. Phil Stevenson, Mortgage Nerd, certified reverse mortgage professional. Happy to help people 62 and over with their homes and their mortgages. Thank you.